Australia's biggest bank just posted its worst single-day fall since listing in 1991, but the quarterly numbers alone cannot explain a 10% collapse. CBA reported a quarterly cash profit of $2.7 billion, which was only 1% below its first-half average. That marginal miss would ordinarily move a stock by a point or two, not by 10. What moved it by 10 was what arrived the night before: the federal budget's decision to abolish negative gearing for new investment properties and replace the 50% capital gains tax discount with a model closer to inflation-adjusted indexation. Treasurer Chalmers framed the change as a generational equity fix. House prices have risen more than 400% since the CGT discount was introduced in 1999. But Jarden analyst Matthew Wilson translated that policy shift into a lending forecast, a 25% reduction in housing credit growth. That is not a marginal adjustment for a bank whose investor loan book is the largest in the country. Investor mortgages carry wider spreads, higher return on equity, and historically better asset quality than owner-occupier loans. When that segment contracts, CBA's revenue mix deteriorates in ways that compound across rate cycles. The market did not price the quarterly result. It priced the structural change in CBA's forward loan mix, and institutional net selling overwhelmed retail accumulation in the session, dropping CBA below BHP in market capitalization for the first time in years. What that shift in cap rank reveals is not just a bad week for CBA, it is a repricing of how much premium the market will assign to a mature bank whose single largest growth channel just got legislated away.
The credit repricing from the CGT reform is the proximate trigger, but it accelerated a correction that the valuation had been building toward independently. Even after the 10% fall, CBA still trades at roughly 25 times earnings. National Australia Bank, its closest domestic peer, trades closer to 19 times. That 6-turn gap is where the sell-off found its fuel. The quarterly result and the budget gave institutional holders permission to exit a premium they could no longer defend to risk committees. Morgan slashed its price target to $119.40 and retained its sell rating, implying a further 24% downside from current levels. Morgan Stanley and UBS both hold sell ratings with targets near $130. The convergence of 4 major brokers on the sell side, simultaneously post-result, is not routine. It suggests the consensus had been holding a quietly bearish stance that the week's events finally validated publicly. CBA CEO Matt Coman added one more layer by lifting collective provisions by $200 million, citing geopolitical and macroeconomic risk. Increasing provisions while reporting a quarterly profit decline signals that management expects conditions to deteriorate further, not a message that supports a 25 times multiple. The position question now is whether the $160 range holds as a floor or functions as distribution. If home lending growth among the major banks, currently averaging 3.7% annualized, slips toward 2% as the CGT reform reprices investor demand, the revenue base supporting CBA's premium multiple becomes structurally thinner. That credit growth rate is the variable worth watching, not next quarter's headline profit, and it points to a mechanism operating simultaneously inside a second heavyweight that the bank narrative alone does not illuminate.
The ASX Healthcare Index fell 4.46% for the week, but the number understates what actually happened to CSL's investment thesis. CSL was not just a stock that missed guidance, it was the market's canonical example of a bottom-drawer blue chip, the kind of stock analysts described as buyable and forgettable, comparable in durability to CBA itself. When CSL cut full-year revenue guidance to US $15.2 billion, down from US $15.6 billion last year, and flagged up to US $5 billion in non-cash impairments across FY26 and FY27, the market did not reprice a bad quarter, it repriced the entire defensive classification. The stock fell 16% on the day of the update, touching a 9-year low of $93.63. The specific mechanisms behind the cut are not random. A US $300 million headwind from immunoglobulin channel inventory normalization, US $200 million from China albumin pricing pressure, and US $150 million from Middle East disruption. Each of those 3 is recoverable independently, but their simultaneous arrival signals that CSL's global supply chain is exposed to geopolitical and trade disruptions in ways that prior guidance cycles did not price. Morgan's slashed its 12-month target from $241 to $147, maintaining a buy rating.
A 39% target reduction while holding conviction is the broker's way of saying the impairment is real but not permanent. The condition that distinguishes recovery from structural break is whether immunoglobulin market share stabilizes. Management cited green shoots in that metric, and the Securus vaccine unit separation scheduled for July 2026 removes one earnings drag from the core business. If immunoglobulin share holds in the next quarterly update and China albumin volumes recover into the second half, the case for reaccumulation strengthens. But if the Middle East disruption extends into FY27, which is what EOS's $726 million defense order book suggests is the market's operating assumption for that region, then the revenue recovery that CSL's remaining buy ratings are priced on may arrive later than the targets assume. Two of Australia's largest blue chips repriced their defensive status in the same week, and the budget's structural demand shift is the common thread connecting both. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.